Hey everyone, and welcome back to the channel where we demystify the complex world of finance. Ever wondered what makes a stock hard to borrow and why that can sometimes signal a potential short squeeze? Today, we're diving deep into a fascinating microcap situation, focusing our educational lens specifically on the ticker symbol INLF. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show INLF logo/ticker on screen. Our focus today is INLF. This is a microcap stock, and interestingly, its specific sector isn't widely reported, which isn't uncommon for companies of this size. But what has brought INLF to our attention isn't its sector, but its intriguing hard-to-borrow status. Now, before we get too excited, let's look at the current price action and volume. Short chart snippet with price and volume info. Over the last 5 days and 30 days, INLF has shown a plus 0.0% change, and today's change is also plus 0.0%. More critically, today's volume is 0 shares, with a 30-day average volume also at 0 shares. This means despite the unusual borrow metrics we're about to discuss, there's currently no trading activity for this stock. What is cost to borrow and why it matters? So, what exactly does hard to borrow mean, and what is this cost to borrow fee we keep hearing about? Simply put, if you want to short sell a stock, you first need to borrow shares from someone who owns them. The cost to borrow, or CTB, is the annualized interest rate or fee you pay to borrow those shares. It's like renting a car, you pay a daily or annual rate for the privilege of using it. Why does it matter? Because for short sellers, this fee eats into their potential profits. A high CTB usually indicates two things: either there's very high demand from short sellers to borrow the stock, or there's a very limited supply of shares available to lend out. When this fee starts to climb into the triple digits, it tells us the market for borrowing these shares is extremely tight. Why this stock is hard to borrow right now. Display CTB full squeeze score numbers on screen. And this is where INLF gets truly fascinating, despite its current lack of trading activity. Our screener shows an astronomical annualized cost to borrow fee of 717.3% for INLF. Think about that, over 700% interest per year to hold a short position. That's an incredible amount of pressure on short sellers, if any are currently active. While the shares currently available to borrow are unknown, suggesting tightness, we do know INLF has an estimated float of just 1.0 million shares. A small float means there are fewer shares overall for short sellers to borrow, and any sudden demand or supply crunch can quickly drive up borrow fees and, potentially, the stock price. Our internal composite squeeze score for INLF sits at 41.0 out of 100. This is a moderate score, indicating interesting potential but by no means a guaranteed setup. Again, it's vital to remember that despite these sky-high borrow fees, INLF is currently showing 0 volume. A short squeeze requires significant buying pressure and volume to materialize, which isn't present right now. This means INLF is purely a watch for potential future activity based on its hard-to-borrow status. Squeeze mechanics explained. So, how would a short squeeze play out with a stock like INLF if it were to become active? A short squeeze happens when the price of a heavily shorted stock rapidly increases, forcing short sellers to buy back shares to limit their losses. This buying to cover their positions creates even more demand, driving the price even higher in a snowball effect. In a stock like INLF, with a tiny 1.0 million share float and a 717.3% cost to borrow, any significant buying interest could theoretically ignite a rapid movement. The extreme cost to borrow would quickly make it unsustainable for short sellers to maintain their positions, pressuring them to cover. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also mean short sellers have extremely high conviction in their bearish thesis and are willing to pay those massive fees to stay short. Dilution risk check. One major factor that can completely negate a short squeeze is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can create selling pressure and offset any buying from short covering, effectively suppressing a potential squeeze. For INLF, our check found no recent dilutive SEC filings like -1, -3s, or 424 BS in the last 90 days. This is a positive sign for any potential squeeze thesis, as it suggests the company hasn't recently flooded the market with new shares. Recent reverse split watch. Now, this is a significant factor for INLF. INLF executed a reverse stock split, a 1-4-200 split, on July 6, 2026, which was just 22 days ago. Show date on screen. A reverse split reduces the number of outstanding shares and, consequently, reduces the float, which can make a stock even more prone to volatility if demand increases. It also proportionally increases the share price. Historically, for many microcap stocks, reverse splits can be a catalyst for renewed volatility or even a price pop within about a month after the split. While this is a pattern observed in some microcap stocks, and not a guarantee for INLF, it's certainly a dynamic to be aware of within this roughly 30-day post-split window. Again, a quick reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given INLF's current zero trading volume, the immediate focus isn't on price action, but on potential future catalysts. The key thing to watch for with INLF is any sudden, sustained increase in trading volume. Currently, with zero volume, there's no market for a squeeze to happen. Any new company-specific news, whether positive or negative, could potentially spark interest. Also, keep an eye on any changes in the cost to borrow or the number of available shares to borrow if that data becomes available. And don't forget the historical tendency for microcaps to see renewed volatility within that first month post-reverse split, a window INLF is currently in. Remember, microcap stocks, especially those with extremely low liquidity like INLF currently, carry extreme risk. So, INLF presents a unique educational case study, a microcap with an incredibly high 717.3% cost to borrow and a tiny 1.0 million share float, all within a month of a 1-4-200 reverse stock split. While the current zero trading volume means there's no short squeeze playing out right now, these are the kinds of underlying metrics that can make a stock hard to borrow and worth keeping on your radar for potential future volatility. Always conduct your own thorough due diligence, understand the risks, and never invest more than you can afford to lose. If you found this deep dive into INLF's hard to borrow status insightful, please hit that like button, subscribe for more educational content, and let us know in the comments what other unique stock situations you'd like us to cover. Thanks for watching, and we'll see you in the next video.